In this video, I'm going to talk about options and if they are for you. Hey guys, I have decided to come up with like a series of tutorial about options before I talk about my contrarian rants in future because they're going to contain a lot of data from options. So it is important for you to understand options before I try to come up with more advanced talks and conversation. Before anything, please subscribe if you want to see more videos and part 2 of this video. Know that I am not a financial advisor and I won't be liable for your potential loss. Do your own research. Do not rely on me only. There are plenty of other videos on YouTube you can watch before making your final decision. Here we start. At the end of this tutorial series, you will be familiar with option mechanics, how they work, what are calls, what are puts, and you will also know if options are for you or not, because just like anything else in the world, every options also have pros and cons and they may not suit everyone. And note that this tutorial is not going to promise to make you rich. So if you want to become Bill Gates, Jeff Bezos, and others, do not watch this video. You're not gonna be like them by watching this video. For today's presentation, we're going to talk about what options are, some of their pros and cons, and how options are priced. I'll show you a quick demo at the end to see how these options are priced using real data. At the time of recording this video, markets are closed. I may not have very accurate data for bids and ask spread, but whatever we have should be good enough to make our point. What are options? Options are contracts that allow you to secure buying or selling rights of an underlying, which can be a stock or future, for a given strike price at a specific time. Each option gives you the right to buy or sell 100 shares of a stock, and if it's a future, it will be one contract. For the sake of this tutorial, we won't cover futures for now, so we stick with stocks. We have two types of options. We have calls and puts. Calls are the ones you buy when if you think an underlying is going up, and puts are contracts that you buy if you think an underlying would go down. You do that when you're bearish on a stock. By the time an option is expired, you can buy 100 shares of that stock for every call contract, and you can sell 100 shares of that stock if you had bought a put contract. Note that you don't have to wait for options until the expiration date. You can trade options as long as they're not expired. I personally never allow options to go to expiration date because it gets just too complex. Let's go through an example to understand how options work better. Let's assume XYZ stock is trading at $100. Jack believes XYZ will go up within the next 30 days. And Jane already owns XYZ and she doesn't really mind closing her position if it goes higher. So Jack buys a call option for 105 strike from Jane at $2, which expires in 30 days. If XYZ goes above 105, Jack will have the right to, this is a typo here, Jack will have the right to buy Jane's 100 shares of XYZ at the time of expiration. And if XYZ stays below 105, Jack's option will expire worthless. Note that again, you don't really need to wait all the way till expiration date. So in this example, Jack and Jane do not need to wait all the way till the expiration date. But for the sake of simplicity, we assume they both waited until the end. This is the profit loss simulation of this trade after 30 days. The yellow line shows Jane's profit and loss, and the green light shows what Jack would gain in this trade. As you can see in this diagram, for Jane, the break even is $98 because she sold a call for $2. And if stock is $98, she would be even. If the stock goes under $98, she would start losing money because she owned 100 stocks. If stock stays at 105, she would, oh, sorry. If stock stays at 100, it means she has not made any money on the stock, but she collected $2 of premium for selling that calls, and each option equals 100 shares. So 2 times 100 is 200. So she can keep that $200. So her overall profit would be 200. And if stock goes to 105, she would make $500 on the stock and $200 on the call option that she sold. That's why she would have at the end, she would make $700. What she had essentially was a covered call. She had this little $2 of protection on the downside. That was the advantage of her trade. But in stock market, you don't get free lunch. So she gained this advantage. However, she had to cap her upside limit. So if XYZ goes to 120 or 200 or 1000, she is going to make $700. That would be her max profit. So in theory, yes, she's going to make $700 only, but in reality, it's very unlikely that an underlying immediately goes from 105 to 1000. That's why I kind of like Jane's trade here better than Jack. Now let's see how Jack would perform here. So Jack bought the call options for 105 strike price at $2. For him to make money, XYZ should be higher than 107 by the time it expires because he paid $2 for a 105 call option. So it means his break even is 107. And if stock goes to 120, for example, he would be making $13 or $1,300. And if stock goes to 1000, the profit is, I cannot even do the math anymore. He's going to make a lot of money. And if stock goes to zero, he would still lose $200. So he has a very defined risk. They call this a defined risk trade. He's not going to lose more than 200, and he's going to make millions of dollars in theory if stock goes to 1000 or $100,000. But that is not going to happen. So in practice, Jane's trade has higher probability of success, and Jack trade does not win all the time. So I hope you understood how this worked. So now let's do some comparison between options and stocks. In short, comparing options to stocks is like comparing a BMW to Prius. Here, Prius would be the stock and BMW would be the options. There are people who prefer driving a Prius and there are people who prefer driving a BMW. There is really no right or wrong answer to this. So this is exactly the same with options. Options has its pros and cons. If you don't really like options, you can just stick with trading stocks. There is nothing wrong with that. Let's go through some of the pros and cons in detail. Stocks have much higher liquidity than options. Not all the stocks or futures have options, so they have very limited options, and not all of them are liquid. Only a plenty, maybe like 50 of them at a given time have liquid options, but stocks are pretty liquid usually. And liquidity means how fast you can get in and out of a trade, which means the bid ask spread for an underlying is really tight and the volume is large. If an underlying has a very wide bid ask spread and has very low volume, I don't call that a liquid underlying. So you see a lot of those in options. So that's what stocks wins in that department. Stocks now have less fees than options. Pretty much the majority of brokers in the United States charge nothing for trading stocks. There are some exchange fees and like additional fees that are very, very minimal. On the other hand, options are a lot cheaper than what they were before. I believe in late 70s and early 80s when options were first introduced, the contracts were really, really expensive, maybe $100 per contract, but now they're pretty cheap. Most brokers charge you something like $1 per contract or zero, and some of them even charge you nothing when you close an option. They only have 20 cents, 30 cents for exchange fees and some other fees. And options win in buying power reduction. When you buy 100 shares of a stock, if let's say in our example XYZ was trading at 100, essentially you're blocking $10,000 of your money. However, if you buy an option for XYZ, in our previous example, we only bought $200, so it would only block $200. So options definitely wins buying power reduction game because of the leverage that it provides. Is it good or bad? It's subjective. And then the risk management also goes to options. With stocks, you can either go long or short. With options, it's totally different. You can adjust, you can go long and short. Also, on top of that, you can be neutral, and also you can adjust how long or how short you want to be, as well as you can also trade volatility. And in terms of speed, stocks and options are both fast. What I mean by speed is when you open a trade, it has a big move, so you can close your position very fast. Stocks are pretty fast. As they move, you make money, but with options, sometimes for longer time duration ones, you need to wait for that trade to become successful. So if you have an option and the stock moves by 10% up or down, you may still need to wait for your options to come into profit. So, but if you have like a shorter term option, it can move pretty quickly. Both of them would win this category. And then volatility trading goes for options. You can totally trade volatility using options by selling options in high volatility stocks. You can even trade VIX options, but in stock you cannot really trade volatility. You can trade some ETNs like UVXY or VXX or some other VIX related ETNs if you want to trade volatility, but they are pretty limited, and I would not recommend trading those as a stock because they can move really, really fast. So again, options wins volatility trading department. And for scaling, so what I mean by scaling is that let's say you own a hedge fund which is managing 1 billion or more of assets. There are so many stocks out there, so you can use that $1 billion to buy stocks in S&P 500 or Russell 2000 or whatever. But with options, there is not enough contracts to cover that. I don't really know. I don't have $1 billion, so I don't really know how much money you can buy using options. But I believe if you're managing money under $100 million, you should be fine. Anything over that, it might be very problematic. I believe Warren Buffett himself sometimes trades options, but it's a tiny percentage of his net worth. So if you're like Warren Buffett or Jeff Bezos, options are not really for you. Interest on margin is the last item that options win. What it means is that let's say you open a margin account in one broker and borrow money from your broker to invest in XYZ stock. They usually have 8% or more interest on that money that you borrow. But with options, if you use margin, there is no interest on that margin. I think this is a really big advantage to options, because if you borrow money to buy stocks and if the interest rate is 8%, you have to pay that 8% to your broker, no matter if you make money or you lose money. But with options, there is really no interest paid on the borrowed money. So it is a big advantage to options. So how options are priced? Options are priced based on few factors. There is a whole big formula that I don't want to go through that. It's pretty complicated and it's not really something you could use to trade. So we'll go with these five items that I think they're very important. Strike price, it's a deterministic um, criteria to price an option. What strike price means is the price that you think an underlying would settle in at the end of the expiration date. In our XYZ example, 105 was called strike price. You can have 110, 120, 130, or whatever. And then time to expiration is also a very known thing. At any given time, you know how many days are left to an expiration for a given option. So in our previous example, it was 30 days. And interest rates are also priced into options. This is not something you can really make any trade based on, so it's not that important. And stocks that pay dividend also affect their option pricing. So this is also not that important most of the time. And but the most important part about an option pricing is the implied volatility. Implied volatility basically indicates like how market is predicting the underlying would move in future, up and down. It doesn't really tell you the direction. It's just trying to find the magnitude of the move. As an example, Coca-Cola usually trades around $50, or let's say Coca-Cola trades at $50. You know after 1 year it's going to stay between 55 and 45, let's say. So it has a very low implied volatility in general. On the other hand, you have Tesla, where every day it can move by more than 10%. So usually those stocks have higher implied volatility, so their options are usually more expensive. So let me show you a demo of how option chain look in real life. So this is Tastyworks trade page, and we are using Facebook as an underline. And this is the on the center you see an option chain, and on the and as you can see here is July 31st. This is the options that expire on July 31st. This is a weekly options, and W indicates that. August 21st is a monthly option. It's the third Friday of every month. That's when most people trade options. And in this page, I show everything. Let's take a look at the option prices for August 21st for Facebook. Markets are closed, so the numbers that you see may not be accurate, but they should be good enough. Let's show 20 strike, it is easier. As you can see, Facebook is trading at 230, which is right here in the center. The right numbers are all puts numbers, and then the left ones are all for calls. Any put that is, all the puts that are under 230 are called in the money, and all the calls that are above 230 are out of the money, and all the calls that are under 230 are in the money, and all the puts that are above 230 are out of the money. Anything in between is called at the money. So for the pricing, let's say you are bullish on Facebook and you want to buy 200, you think by August 21st it will go to 240. As you can see, the bid for 240 strike is 680 and ask is 710. So if you look at the middle price, it's somewhere around 695 is the price for this option. So if you want to make money in this trade, Facebook should go to 246.95 before you can even get any money at the expiration. Note that like if Facebook goes up by $5 a day after you buy it, this option value would be changed so you can close it on a profit. So you don't have to wait for the expiration before you do it. So, but for the sake of simplicity, we just assume everything goes to expiration here. And as you can see, if you want to buy the 245 options, it's somewhere around 525 ish. So it's cheaper than 240 because the strike price is $5 more and there is less chance of Facebook to go to 245. So you will pay less for this strike. So the farther away strikes are usually cheaper. As you can see, 232, it starts from 10 and then it goes down to 325. The farther you go away, the cheaper it will be. Also, month is very important. So let's go back to our example for 240. As you can see, for August 21st, 2020, bid is 680. If you go to September, 240 is 985. So it's $3 more almost. What it means is that there's a higher chance of for Facebook to reach 240 in September because there's more time. So time and strike price are very, very important in determining why a option is priced. But these two are still pretty known. So at any given time, you would know how many days are left for an option to expire. In this case, 53 days, and the other one is 25 days. So it's not really something you can trade. You will never see 240 calls for September will be cheaper than 240 calls for August. If you see something like that, there's something wrong with the quotes. There is no free lunch in the stock market. You're not gonna make any money out of it. So there are some other indicator here as delta and other stuff. So if I click on this, you see more stuff which are a little bit more advanced. So I'm going to talk about these things in future. Make sure to subscribe if you want to see those information. And on the put side is pretty much the same. If you think Facebook goes to 225, you have to pay around 840 as the bid is 840. And if you think it's gonna go to 205 because 205 is very far away from the current price, you would pay less. And again, the same thing, as you can see, 205 for September is 465, which is more expensive because you have more time. And that should be it for today. I'll again make sure to subscribe if you want to see the second episode of my option tutorials. And I hope you enjoyed the video. Please drop me a comment and let me know what you think. Peace.